friend and co-host, Zach Miner. And today we're going to talk about a couple of things. I've got some optimistic notes. I feel like the news cycle has been particularly negative, so I wanted to share a couple thoughts with you. I hope you find them as interesting as I do. Zach, what do you have for us today?
Yeah, sure has been. I'm bouncing around a little bit here today. We'll try to pick it up, a little more on the optimism than we did last week. But every time Jay Powell is on TV speaking, we have to put in some optimistic notes.
Yes, it's interesting times. So that's kind of a great lead off to where I want to start today. The last couple of weeks have been flat-ish for the market. Of course, that's off the heels of a pretty unattractive September and August, both negative months. So, flat isn't necessarily great, but as I usually do, or as I often do here on the Finance Footnotes podcast, I want to take a moment here and step back and kind of give us a litmus test of where we are. And I often use the American Association of Individual Investors sentiment to see where we are. And so the chart I have is from last week, and you can see that from our previous podcast, the optimism, which is measured by the bullish sentiment, has rebounded from a low. So a couple of weeks ago, it was below 30 of folks or investors were optimistic. Now it's it's exactly 40%. And that compares to about 37.5 on historical average. So there has been a rebound in optimism at some level. So we did kind of rebound from that peak pessimism we were talking about just 2 weeks ago. So that's just a little bit of a background for you. So starting it off here with the first optimistic note I wanted to share with you. Interesting, this is about seasonality. And this is from LPL, actually the Wall Street Journal. October 13th began the strongest period of for stocks in the S&P 500. So this extends through year end. Of course, this is going back all the way to the 1950s. And of course, it's not written in stone, but 70% of those occurrences are positive. With a 6.8% average going through year end. So probably about the strongest part of the year, Zach. What do you think?
Yeah, I actually just saw a chart. Don't have it here from Ryan Dietrich, another perennial optimist. That we see on social media, and he said that trend is actually even stronger in year 3 of a presidential term. That you typically get a kind of a choppy market from the summer in through Thanksgiving, and then a very strong seasonal bounce into winter, kind of before you start going into primary season. So I think that we've been following seasonality pretty kind of historical seasonality this year, pretty to a T. So we kind of may expect to see the same.
I quote our friend Mr. Ryan Dietrich here a little bit later. He is a perennial bull, which is nice because he's kind of contrarian to a lot of the other folks out there in the Twitter sphere.
I don't know if you would like we described him as that. As that. He just happens to be bullish now, right? And he's been fairly right. I don't know if he's going to maintain that position or would want to be called a perennial bull, but he has been a contrarian and certainly has been pretty right.
Well, I don't mean to be disparaging at any remark. I certainly like his research, and hopefully, I know he always listens to this podcast.
Right.
Anyway, so moving along, and this is actually, here we go. This is some research from our friend Ryan Dietrich. He's an economist. He used to be at LPL, but we followed him to his other pastures. So this is interesting. I've been sharing this with clients, trying to kind of share some reasons for optimism. One of 2 ideas I'm going to share with you today. And on the screen, I have a chart here, and this is going back to 2010. So it's only 13 years of data, but this is measuring pessimism in the marketplace, and it's through options contracts, puts and calls. That's how you take a bet on the market going up or down. And the level of pessimism to optimism was at a high, and it's been at this high. What do I say here? 8 previous times. We just had the 9th time last week. Okay, so this means that there are 1.5 puts or protections per calls or optimism. So that's a little bit nuanced, but the point is that the pessimism, and that's people putting their money on the table and buying protection, hasn't been this high very often. And so looking back, each time the market was higher on a 3 and a 12-month basis, and that's the green arrows. If you're following at home, you can see that I point them out there, that over 3 months and 12 months, higher each of those times. Of course, that's not written in stone, but I think it could be a positive track here going into the next 12 months, just based on recent trends. So I think that's a point in addition to the seasonality we just discussed. There's some other technical indicators here that suggest things look pretty good going over the next 3 and 12 months.
Yeah, certainly. And I like this indicator because there's a real kind of a technical basis behind for why it happens, right? If you get caught off as a trader, if you get kind of caught off sides, and a lot of these are large, large institutions and large traders putting these options trades on. You get caught off sides, you kind of have to cover, and and there tends to be momentum to the opposite side of the trade. And interesting that the last occurrence was at the end of 2022, and we've kind of seen a quite a strong rebound off the lows of the winter.
Yeah, I like this. I think it's kind of layers on to the other seasonalities that we're seeing out there, and speaks to the point about our one of our general themes here on Finance Footnotes is, if everyone in the conversation is saying one thing, we ought to be contrarian and at least look at the other side of the conversation. So I think this speaks to that point, at least over the last handful of years and occurrences. So
Yeah,
and the 12-month average is 20%. I mean, it's
right.
not
It's not a
it's
couple. Yeah,
meaningful.
yeah.
So cause for optimism there. Moving along, now this is from LPL. This was published late last week. So this is just talking about when bull markets. This is talking about the since 1950, there have been 14 previous bull market cycles, and this is to your previous point, what Ryan Dietrich said, the economist, that the third year of a presidential cycle looks really good. This is talking about the second year of a bull market. So we've had 14 previous bull market cycles since 1950. Every single time the second year was positive, with an average of 13.2%. Now we'll have to see if that trend holds, but this is, these trends, they start to build a foundation that you can work from. They're not set in stone, but I think that this is good momentum in terms of technical indicator. You can see that the average return 13%, the median return 14.5. Pretty, a cause for optimism, I think.
Yeah, 14 for 14 too. It's such a decent sample size. It's a decent, quite a long stretch of history, and to have 100% hit rate, 14 for 14, you certainly want to pick up and take note of that. And it's interesting too that it doesn't feel like a bull market, right? I think if you kind of look around at
That's sure,
how folks
for
are
sure.
positioned and talking about things, right? You don't. It certainly doesn't feel overwhelmingly positive. Um, but yeah, it is right. It by the technical definition.
So to that point you just brought up, part of what I try to do, and I'm having a lot of quarterly meetings and calls right now with clients, and the news cycle is, I don't know if it just seems slightly more negative than usual. Now the news cycle by its very nature is negative. Research shows that 9 out of 10 articles are pessimistic in nature, which kind of segues with our, we're humans, we're evolutionarily, we're predisposed to react to negative news, right? Is that a snake that's going to kill us, is more important to remember. So that's what resonates with us. So, part of what we're trying to do here is just point to some optimistic, reasons that, could run contrarian to what we're seeing in the headlines.
Right.
Cool. So those are just a couple of important points that I've been bringing to folks here. And then just to take one quick sidestep here, that is a cause for concern, and the title of this slide I have is "The Strong Consumer." And what I'm looking at here is, and this was in the Wall Street Journal just yesterday. So we're bringing really fresh insights here. This is just from yesterday, and it's just seeing an uptick in the delinquency rate for credit cards, autos, student loans, and mortgages. So just a slight uptick. I wouldn't say it's above trend, but gosh, could be cause to pay attention here as we go forward. I'm not hyper concerned about this, but something to take note of. What do you think, Zach?
Yeah, I wouldn't be. I'm not concerned with where it is now. Really because the dip that we saw in the 2020-21 period was really because of pandemic stimulus. It was because student loans weren't being paid. They were in deferment or forbearance. So this is kind of just a return to pre-pandemic trend. Those savings have been spent down. Student loan payments are picking back up. Inflation has taken a bite out of household balance sheets. So it's kind of just back to pre-pandemic 2010s trend. It's certainly something to keep an eye on, because if it does continue to tick up, then you do start to see one of those kind of early warning signs of more significant financial stress.
Agreed. And it's certainly just back to the, reversion to the mean, if you will, statistical
Right.
jargon. But yeah,
Yep.
no cause for concern yet, but just something that you're paying us to keep track of for a year on Finance and Footnotes. So just a little thought here as I rebound here into just my final comments here for us today, which I'm really excited about. And I'm going to end with some optimism here. And I think, just as I'm having conversation with clients and friends and family over the last several weeks, it just seems to me there's this negativity at the moment. And I think part of it's because we are in a presidential cycle, and candidates keep talking about how broken things are. You hardly ever hear someone talk about how good something is. So I was really excited, and being a bit of a finance nerd, you are too, my friend. I'm sorry to say,
For
you're in the
sure,
same camp as
absolutely.
me. I was excited to see that yesterday the Federal Reserve Bank released their changes in the U.S. family and finances from 2019 to 2022. Now, I know you're excited at home, sitting on the edge of your seats. This is only released every 3 years, and it was released yesterday. So this is probably some fresh data you haven't seen before. And as I was, it's only like a 30-page PDF, but you'll see a copy of it there on the screen here. There's some really exciting things that I wanted to share with you, and I think it's just completely lost. You might be surprised by a lot of this, but this is kind of taking a step back from some of the nuances here of our podcast, and just kind of talking more generally about the American consumer, about our society, and so all the facts I'm going to share with you here are from 2019 to 2022. But I was just really surprised by a couple of these, Zach, and please chime in here.
Mhm.
I guess before we get started, would you remind us of the difference between median and mean?
Yeah, so the mean is the average, and the median is the middle, essentially. And uh, I'm glad you put both of them up here because the mean can really get pulled up by
Distorted.
the highest cohorts, right? So if you have a few folks at the top that are really doing very very well, the average can go up, and the median is much more representative of kind of what the middle looks like. Like, is the rest of the meat of the population also participating in these gains? And you can see that the mean net worth is up more, right? The average is up more because it certainly has been true that a lot of the wealth that was created throughout the pandemic and over the last 3 years has gone to the top. So their wealth is up. Quick math, what, 15% or so, while the median's actually about the same. Yeah, I'm doing this
So
on the fly, doing math on the fly right now. So
that's what we're paying you,
yeah,
my
yeah, there
friend.
we go.
So just to kind of build off that, let me just run through these with you. Median income, and I think this is kind of lost in the dialogue. You're watching it's political season. You're seeing a lot of commercials out there. You might be surprised by a lot of this, but median income, again, that's the middle observation. 3 years ago was about 68,000, and now it's over 70,000. So the average, the median, middle observation is increased, meaningfully, right, over the last 3 years. This is exciting. And in this particular document from the Federal Reserve Bank, it actually goes back several 3-year segments, and you can kind of see this trend increasing. So I'm only showing you this most recent observation, but I think it's a trend that's been kind of the case over the last 15 years, let's say. So in 2022, median income 70,300, mean, or the average income, double that, 141,000. So those are both up meaningfully. Median net worth, and this was the part that caught the headlines yesterday. If you were paying
Mhm.
attention at home, it was in the Wall Street Journal today. But the median net worth went from $141,000 to 193. It's an incredible increase. Far above what you would have possibly expected. Now, part of that's the COVID stimulus, but part of that's people started investing. More people are owning homes, which we'll get to in a second. So while the median net worth is 193, the average net worth is a million, which of course, a couple of
Right.
billionaires can really make an average up there, as it were. So
Exactly.
those are, but the trend, so that's still, even the average went from 868,000, and that includes all aspects of wealth, to just over a million. Those are big increases, and people are financially better off than they've been in a very long time, if perhaps ever. And no one's talking about that I hear in the world. And I think you probably agree to that, Zach, right?
Yeah, absolutely. A lot of this is home equity, and the fact that the housing market dynamics are what they are. But if you look at some of the other indicators, student loans, debt to income, all positive trends. Own a home, positive
So
trend,
that's
increasing.
I want to hit those last three because I was just really surprised by this. I hear a lot of people talking about the housing market's difficult to break into, and it probably because it's at near Zach, sorry to push this on you, but it seems to me that just before the housing crisis, which is about was fit more than 15 years ago, or just about 15 years
16,
ago.
17, yeah, yeah.
It seems that I think that the max in home ownership was maybe 68%. Does that sound about right to you?
It does, yeah, 2/3, around 2/3, yeah.
We'll double check and report back. But so going back to 2019, 65% of people owned a home, and now 66%. So it is an uptick, a meaningful uptick, a near all-time highs of home ownership. Um, Student loans, we hear so much in the news from politicians about student loans. I was shocked. Only 21% of people have a student loan, which is about the exact same as it was 3 years ago. And then finally, I think this is going back to the strength of the consumer, debt to income. How much debt do you have as a percentage of your income? Going back 3 years is over 100%. Now, this includes student loans and car loans and home loans. And of course, it's across a big cross section of the population, but it dropped to 89% 3 years later. So most recently,
Right,
I think all of this is constructive. I think all of it kind of suggests that the average person in our society is doing measurably better than just 3 years ago. And I think this is optimistic. And I just ask you to remind yourselves of these data points, because the political conversations that or commercials you see, they're not going to highlight any of this.
right, right. Absolutely.
So a couple of reasons for optimism. What do you have going on? I see some exciting charts here.
I'm gonna bounce around a little bit. Looking through them, they're actually not as optimistic. Maybe they're okay. We're gonna start with the Warren Act, which is a pretty good indicator of what the labor market dynamics are going to be in the coming weeks and months, because this is a kind of a federal law that requires large employers to essentially warn people if there's going to be layoffs that are coming, and those really started to tick up through September. And that hasn't shown up yet in the actual initial jobless claims number. So this is something that can kind of precede that happening. You saw that little bit of a spike back in the beginning of the year, where you had some big tech companies that were doing rounds of layoffs, and that did kind of coincide with a bump in the initial jobless claim. So I think you're just starting to see some of that, going into the new year. But we're still at historically low levels. We're mid to high 3% unemployment rate. So certainly not a level where it would be concerning, but it's just one kind of leading indicator that you can follow to keep an eye on the job market.
And only a 12-month period on this chart. So there's a hockey stick at the end of this chart for those of you who aren't watching but listening. We are seeing that, but it's over a shorter time frame. So definitely something to pay attention to, and we'll have to kind of watch this going forward, I
Yeah, this is
guess.
definitely a short-term indicator. It's something that leads by a handful of months. It's a very noisy indicator because it kind of bounces around, but it's something that, if you're looking into kind of where the direction of the labor market's going to be, over the next couple of weeks and months, and which will feed into the decisions that the Federal Reserve is going to make. You can kind of take that as maybe a sign that they won't be as aggressive going into the winter months if they're starting to see some labor market weakness. So it's an interesting dynamic that it actually could be a kind of a positive type of news for the things that the Fed wants to see.
Excellent.
So, and the next one, and I think this has been fairly widely reported, that the market, the S&P 500 in particular, is really been driven thus far in 2023 by the Magnificent Seven. Those seven stocks: the Alphabet, Meta, Tesla, Apple, Microsoft. Did I miss one? Was that six? That was six. Nvidia. Oh, how could I forget Nvidia and Amazon? Okay, that should be seven. Had to tick through the numbers there. It's not as easy to remember as FANG, right? It was an acronym. The Magnificent Seven is not an acronym. But if you kind of look under the hood of the price to earnings ratio of the S&P 7 and the S&P 493, which is the other 493 stocks in the index,
the unmagnificent 493.
The unmagnificent 493. The P ratio for the 7 has gone from 29 to 45 this year, while the 493 is essentially flat. It hasn't really participated in the valuation multiple expansion that the 7 has experienced, and there's been really no earnings growth kind of across for the most part. We kind of been in an earnings recession, so the growth in the market has been multiple expansion, and it's really been multiple expansion in 7 stocks. You kind of look at the overall gain of the S&P 500 of 14-15% or so this year, has really been driven by these 7 names, in the S&P. And you can kind of look at that. You can look at that 2 ways. You can look at that as being a very narrow rally, or a narrow bull market that's really just being driven by a handful of stocks. Or you can look at it at the fact that the other stocks just haven't participated yet, and that they haven't caught up to the rest of the the top heavy part of the market, but that they will. And that a lot of the forecasts that you're seeing, especially with JP Morgan and the big banks, as far as earnings forecasts going into 2024, is that we're kind of done with the earnings recession, and that we've gone through that, and now we're kind of expecting earnings to reaccelerate. And if that's the case, that would benefit the 493, right? If you think that we've kind of weathered the storm of this earnings recession, and now you can have a valuation gap be closed by the rest of the market, that could be a very positive thing. So you can look at this chart 2 ways. You can interpret it, two different ways.
I think this is very topical. The Magnificent Seven are going to be reporting their earnings for last quarter in the coming week, so we'll have to see what happens. The last 2 quarters were generally better, although flat or slightly negative year over year, but better than expected. And just taking a step back from this chart, I think just to revisit what price to earnings ratio is, and often how I explain it to clients, it's if you annualize the revenue a company was generating, how many years would it take for them to buy back all of their shares? It's totally hypothetical, but it helps you understand, the multiples. Price to earnings ratio is probably the most common ratio that's quoted in finance, at least in investments, I think. And that's essentially, it's the number of years it would take a company to buy back. So you can see the Magnificent Seven taking close to 45 years, where the average S&P 500 company taking less than 20. So there's your background.
Yeah, absolutely. And without looking at the next chart, where do you think what was the highest percentage? What country did the US import from at the highest percentage?
Well, I know it just recently changed to our friends to the south.
Okay.
And I suspect it was I suspect it was China, and I'd have to guess, something like less than 50, more than 30.
Yeah. So it's Mexico, our friends to the south. And this, I'm going to share a couple charts that I just included in my quarterly investor letter, which was really focused on kind of the Chinese slowdown and the changing perceptions of the eventual Chinese takeover of the U.S. economy. That was thought to be a foregone conclusion, that they were going to overtake us in terms of GDP. And now that there's a lot of speculation that won't happen for decades and may never happen at all, because of just some of the dynamics of both internal and external factors, with China. But one of the external ones is this kind of reshoring and nearshoring, and countries in the European Union and the US here just starting to think a little bit differently about supply chains, and not necessarily rushing to the least expensive option, but looking at still inexpensive options, but maybe more sustainable and more strategically aligned with just the values and economic systems that we're accustomed to. And so I thought that this was,
it's very interesting. And President Xi of China was just talking about this yesterday with the Russian president, who we don't talk about in this podcast. But he was talking about, strategic decoupling, and that's just an expression I haven't heard before, but it's incredible. I mean, looking at this chart, you can see that the Chinese percentage of our imports went from about 20% and down below 15, while the Mexican imports have just been a steady increase. Gosh, this is I love it. It's a 30-year chart, folks. Very exciting. And you can see over that time steady increase for Mexico.
Yeah, and other countries have benefited too, right? Vietnam and South Korea and Singapore and the Philippines and many other Asian nations as well, but also South American and obviously Mexican companies.
Do you think any of this? Obviously there was part of Trump's policy was to hold China more accountable for our deficits and to be more equilateral trading partner. But I'm seeing a huge dip here from COVID, and I know that we had to, the supply chain had to be more strategically aligned during that time. Do you think part of it's that as well?
Absolutely. Oh, so this, yeah. So this trend, it started back, and you kind of see 2016, right? And so tariffs being put into place on the Trump administration. You see the dip start there. But it wasn't just that. It was, I think, and companies are gonna do what's best for their shareholders. They're not really gonna pay too much mind to the political wins. They're going to do
Mhm.
what's best for their business. So I think that there was just a sense that China was just becoming less friendly to business, and not even a sense. It was written in plain black and white. They were torpedoing IPOs and removing executives and forcing companies to provide intellectual property to them. And there was just a lot of things that made it an unfriendly environment. So I don't think it was, just the tariffs or just the political wins. And then obviously the COVID supply chain issue just accelerated, right? It was fuel on the fire and made it kind of in, in, enhance the immediacy of what they were doing. They were kind of already doing it, but that made it like, well, now we have to do it because China's closed, right? We literally can't purchase things from there, and there's bottlenecks and shipping bottlenecks. So we kind of had to look to other options. So I think it was just an acceleration of a trend that was already in place. But I don't think it's an easy one to turn around. I don't think this is something that you're going to see flip back the other way, anytime soon. It's a lot of logistical work to retool your global supply chains, and I think once they're in place, you kind of you just let inertia tends to carry it forward. So I wouldn't expect this to really change.
It's incredible. And I want to turn back to your phrase, strategic enhancement. I mean, folks, that's why you're tuning in here to Finance Footnotes for these really clever turns of phrases, Zach. I was
Absolutely,
impressed.
absolutely. And the second thing about China here is that um, they have and this is something that the whole developed world is going to be facing over the coming decades is population decline. But China's really going to be, facing this kind of two ways. First, by low birth rates. So I have three charts here on the slide. The first one on the left is just the Pew Research Center essentially projecting out population in China through 2100. The median case is that they lose half their population. The high case is that it goes down by about 25%. The low case is that it's 60% plus declines, in their population. And that's really by two ways. The first is that they're just not having enough babies. They don't have a replacement rate of births. Even after the one child policy was rescinded, it continued to fall, and that's a function of becoming more of an advanced economy, because we see that in the US, we see that in Europe. We as economies do become more wealthy and more economically advanced, typically the birth rates do come down because you don't need as many children to work in your agriculturally, and the infant mortality falls, so there's a higher chance that your children will live. So you expect to see that, but it's been a significant decline. And then the other problem with China is that people are leaving, they're emigrating.
This is what really surprised me. This chart I saw in your newsletter today. Of course, I'm subscribed. You can too if you want to message us. Zach will happily add you to his list. But this
Absolutely.
this last chart was really surprising to me.
Yeah, I mean, just constant net migration, going back really through, and it's been multiple different regimes and different political systems. So, in the early 70s, 80s, 2000s, I don't know if you can take too much out of that. But even since this kind of hybrid authoritarian capitalist model that they've been trying over the last 20 years, still constant net migration,
And this is from
leaving
this is from
China.
the Pew Research Center, and they're projecting out until 2100 again, a net migration annually of over 300,000 people. The best
Right.
guess. Wow, incredible.
Yeah, and so those two trends together, lead to a situation where that population is going to be in decline. The population that they do have is going to be older. So it all of that feeds into this concept that China may have reached its peak, or it economically may still grow a little bit, but it's no longer that foregone conclusion where they're going to overtake the U.S. And it's in my newsletter again, I kind of pointed back to the 80s where it was just assumed that Japan was going to, overtake the US economy. And we kind of saw what happened over the subsequent 20 or 30 years, with the Japanese economy. So it's just an interesting thing that you kind of always have to just challenge your assumptions about these global economic trends.
Fair enough.
And then the next one I have here, and like I said, we're bouncing around, so we're gonna bring it back to domestic consumer spending. And I thought that this was quite interesting. So going back to 2005 through 2022, the perils of working at home. We got the dog barking at something. So 2005 to 2022, this is share of consumer spending by age group. And just since the pandemic, it is now the baby boomers who are spending the most into our economy, overtaking all other age groups. And I obviously, if you go back to like, these are some of the same people, right? Because if they're 65 and older now, right? But they were in the lower cohorts 20 years ago, right? So it's some of the same people transitioning through these cohorts. But I thought it was interesting. You see a lot of the advertising that you see, consumer advertising is very, very heavily focused on young people, but 22% of consumer spending is now 65 and older. I thought it was an interesting consumer trend that
It's a
was
great
not
chart.
aware of.
All the other age groups here, which look to be in about 10-year increments starting at age 25, they're all coming, over the last 20 years, they're coming down from the left to the right. So they're moving down significantly. The only one, well, yeah, about the only one that's moving up meaningfully is that 65 years or older cohort.
Right. It's very interesting. And a lot of that is just the dynamics of the housing market and the equity markets, and the fact that these folks have benefited greatly from a lot of the appreciation, asset price appreciation of the last 20 years. A lot of it has gone to the older generations because they've owned homes and they've had 401k balances and have been saving through the 2000s and 2010s and have benefited from the most recent bull market run. And so now they're spending it. But I think if you would have asked, and really me or anyone, before seeing this chart, what's the what cohort of 10-year increments is kind of spending the most, I don't think you would really have guessed the 65 and older crowd.
Yeah, I think that's correct. Maybe part of that's just thinking out loud here. Part of that's perhaps to the healthcare expenses. We always hear about how
Absolutely.
Healthcare is extra inflationary, and of course, that's when you spend the most of your money on healthcare as a percentage of your income is that age group. So that must play into it.
Yeah, absolutely.
I'm
And then the
excited
last
about this
one,
last
yeah,
chart. This looks
yeah,
this is very intriguing.
last one I have here is looking at that yield curve inversion, right? And we've always we've been talked about it several times, and you've heard it on the financial news, and that the yield curve inversion tends to portend recession at some point, but it's a good indicator of an impending recession, but it's a bad timing indicator
Can you
because
take a step back and tell us what a yield curve inversion is?
absolutely. So that is when the short-term rates in the market, so your 2-year treasury, for instance, is higher than your long-term rates. So your 30-year treasury, for instance. And I think the 2-year is I think it just hit 5.3 or so percent. The 10-year is creeping up towards 5%. But the shorter term rates in the market are higher than the long-term rates. And generally that just indicates something about the economy, because longer term rates are more determined by inflation expectations, economic expectations. So if those are lower, that's just the market's way of telling you that economic conditions in the future will be softer. And so when you have that set of conditions, you tend to eventually get a recession. But it's a bad timing indicator. It generally takes years for when you have that initial inversion to a recession actually showing up, or really showing up in the employment data. And so this chart really just looks at the prior 7 recessions, then when we've had after a yield curve inversion, and how long it took for unemployment to really tick up, the change of initial unemployment claims. And if you look at that, we're kind of right on track, right? It's not surprising that it hasn't ticked up yet. It's been almost 13 months, I believe, since the yield curve inverted kind of for the first time. And it's not surprising that we haven't had a tick up in unemployment yet. But if you kind of go back to that Warren Act, chart, where it's like, hey, in the next 12 months, you would expect it to start having an effect on the economy and potentially see unemployment start to trend up.
And if you're looking at this chart, there's what, seven other experiences in this time frame, which I suppose goes back to 1969. So there've been, this is what the eighth occurrence, and you can see the rest of them almost at exactly at this 13 to 15 month pivot point, just streak upwards in terms of unemployment rates. Of course, we'll have to wait and see what happens. Every occurrence is different, but yeah, gosh, might be bringing it back to the 30,000 foot level could be the impetus for the Federal Reserve Bank to end its current interest rate policy and perhaps even lower interest rates as they predict.
Yeah, and that's kind of what, and the market's almost telling you that. Like, that's kind of partly why longer term rates are lower, because it's pricing in that the Federal Reserve is going to lower them, and they're going to have to lower them because of economic weakness. And with what treasury, I mean, the 10-year touching almost 5%, highest since 2006, 2007, 16, 17 years. The market is doing some of the work for the Fed. So I've heard some, I believe it was Bullard or I forget who was actually saying it, but that the market is kind of doing some of their work for them, some of the tightening for them. So you may still see another hike in November, because they've kind of telegraphed it, or December, but I would expect them to probably be done pretty soon, because I do think that we're gonna just start to see some of the economic weakness that we haven't seen yet, hasn't materialized
I
yet.
I can't help but agree. It seems to me that, for those folks sitting at home or listening, I think it could be a good time to look to add duration to your fixed income assets. And that's
Right.
something you'd speak with your financial advisor about on a case by case basis. But it seems to be a decent time to have that conversation.
Yeah, definitely.
Well,
That's all
thank
I
you for
got,
the
my friend.
smart. Well, I was going to end the conversation with whether or not we should take a bet, you and I, as to whether or not the 10-year was going to go above that 5% inflection point by the time we do our next podcast. But gosh, I was just checking the numbers here
Is it
before I
above?
asked that. No, it's added. So I think it's almost a certainty that it's going to poke above that before we have the chance to speak to you again. But
Wow.
we'll certainly talk about that in a couple of weeks. Thank you for joining us on Finance Footnotes. We'll
Well,
look forward to seeing you
uh,
next time.
take it easy.